The strategy that takes you from $10,000 to $50,000 is the exact strategy that keeps you stuck at $200,000. That's the part nobody warns you about. Most people find one playbook early, fall in love with it and run it the whole way up, then stand there confused when the thing that used to work quietly stops working. Your investment strategy is supposed to change at least 4 times between $10,000 and $1 million, not because the old moves were wrong, but because they were right for a different amount of money. What builds a foundation is not what compounds it, and what compounds it is not what protects it. So let's climb from 10 grand to 7 figures and mark the exact switch points, the moments your strategy should change underneath you, and what most people do instead. $10,000. The job isn't returns, it's not losing it and not needing it. At this level, obsessing over which fund to pick is like arguing about paint colours before you've poured the foundation. The math is blunt. $10,000 growing at a great 10% return earns you $1,000 in a year. Adding $500 a month earns you $6,000. Your savings rate absolutely dwarfs your return rate, and it will keep dwarfing it for years. So the strategy here is boring on purpose. An emergency fund, so you're never forced to sell at the worst moment, kill any debt above roughly 8% interest because that's a guaranteed tax-free return no investment can promise, and put the rest in one broad index fund. Stop optimizing the portfolio, optimize the paycheck. At $10,000, your income is your investment strategy. $25,000. Automate it, then attack your income. Now the foundation exists, and the temptation is to start tinkering, picking stocks, chasing the fund that did well last year. Resist it. At $25,000, the single highest return move available to you still has nothing to do with the market. It's a raise, a certification, a side income, anything that widens the gap between what you earn and what you spend. That gap is the engine. Automate your contribution so the decision is made once and never again. Then spend your actual energy on the paycheck, not the ticker. And here's the behavioral shift most people miss. Stop checking the account. At this size, watching it daily only tempts you into moves that cost you $50,000. The first real fork in the road. This is where your strategy earns its first genuine decision, because $50,000 is roughly the level where leverage becomes physically possible. With a low down payment loan, this can control a $250,000 property, and that 5-to-1 multiplier is something no index fund can hand you. This is the fork. Keep it simple and fully passive, or take on the complexity, the tenants, and the risk of real estate. Here's the honest filter. Real estate wins at this level only if you can put money down and still keep 6 months of reserves untouched behind it. Because the day you own a rental, you've also bought a furnace that dies in February and a tenant who might stop paying. If a single bad month would force you to sell, you're not ready. And stacking index funds is the smarter, richer in the long run move. If you have the reserves and the appetite to run it like a business, this is the stage where real estate can genuinely pull ahead. Most people should keep it simple. The ambitious with real time to spare have a real opening. $100,000, compounding finally wakes up. The first 100 grand is famously the hardest, and there's a reason it feels like a wall. Up to here, almost all your growth came from money you added. Around $100,000 that flips. A normal 10% year now earns you $10,000, which is more than a lot of people can save. In a year, for the first time, your money is out earning your effort. So the strategy shifts from add as much as possible to add and don't blow it up. This is where diversification stops being a buzzword and starts being protection, because now there's enough on the table that a single stupid concentrated bet can undo years of saving. Keep feeding it, but stop treating it like a lottery ticket. It's an engine now, and engines don't like being redlined. $250,000. Run a concentration check. By now your strategy has a new enemy, and it's not low returns. It's putting too many eggs in one basket without noticing. Maybe it's a pile of your own company's stock. Maybe it's a single rental that's now most of your net worth in one zip code. Maybe it's one fund that ran hot. At $250,000, the move is to look honestly at where the money actually sits and de-risk anything that could take you down 40% by itself. The strategy quietly changes from pure accumulation to allocation discipline, rebalancing, trimming winners that have grown too large, making sure no single event can erase a quarter of everything you've built. This is unglamorous, and it's exactly what separates people who reach $1 million from people who touch $250,000 and slide back. $500,000. Time becomes the constraint, not money. Something sneaky happens near $500,000. Your hours start to be worth more than the returns you're chasing by hand. If you're self-managing rentals, do the math on what your time is actually worth now. The weekends, the 2 a.m. calls, the coordinating repairs on your lunch break. There's a point where hiring the management, or shifting toward hands-off ownership, makes you more money by freeing you to earn elsewhere. This is also the level where taxes become a real lever. Maxing every tax-advantaged account, thinking about which assets live in which account, deferring what you can. At $500,000, the tax code is doing more to your net worth than your fund selection is. Your strategy should shift from picking investments to structuring them. $1 million. The game changes from getting rich to staying rich. You've made it to the 2 comma club, and here's the twist. Nobody tells you at the party. The strategy that got you here is now your biggest danger. A crash at $1 million costs you more in dollars than your salary can replace in years. A 40% drop is $400,000 gone, and no paycheck fills that hole fast. So the mission changes. It's no longer swing for the fences. It's preservation and optionality. Enough diversification that nothing sinks you, enough cash buffer that a bad market never forces a bad decision, and enough freedom that the money starts buying you choices instead of just growing a number. The people who lose it after making it are almost always the ones who kept playing the $50,000 game with a $1 million balance. Now let me be fair, because if I only handed you the ladder, I'd be doing what every guru does. Every stage has a trap. Index funds are brutally volatile. The market fell 37% in 2008 and 34% in a single month in 2020. And most people panic sell at the bottom and buy back after the recovery, locking in the loss. Real estate is illiquid exactly when you need cash, concentrated by nature, and quietly eats your weekends. And the biggest risk across every single stage isn't the asset at all. It's you, changing strategy too often, chasing last year's winner and abandoning a good plan the moment it's boring. The math is rarely what kills people's returns, their own hands are. So here's the whole thing in one breath. At $10,000, your savings rate is the strategy. At $25,000, your income is. At $50,000, you choose whether to add leverage. At $100,000, you protect the compounding that's finally started. At $250,000, you check your concentration. At $500,000, you buy back your time and structure your taxes. At $1 million, you stop trying to get rich and start making sure you stay that way. Same person, same goal. 5 completely different playbooks. The mistake was never picking the wrong investment. It's refusing to change the strategy when the number changed. The move that's smart at $10,000 is reckless at $500,000, and the caution that protects you at $1 million would have kept you broke at 10 grand. So before your next contribution, your next property, your next hot tip, ask the one question that actually decides whether your plan still fits. Is this strategy built for the money I have now, or the money I used to have? Because the balance changed. The strategy was supposed to change with it.